despite working really hard. That dream of owning a home just seems, well, further away than ever.
Yeah, it's a common feeling.
Or maybe you felt that the fundamental rules of money are like some kind of secret language,
Right.
one that only a handful of people truly understand.
Mm.
It's this pervasive feeling, isn't it? The sense that the economic game is, I don't know, rigged, or at least that the rule book we're all given doesn't quite match what's actually happening on the field.
That's a good way to put it. The official story often feels off.
So today, we're taking a deep dive into exactly that. The real-world implications of our current financial systems on, your prosperity, your economic stability.
We're going to try and connect some dots.
Yeah, we'll unravel how money is truly created, and it might surprise you.
Oh.
We'll demystify the nature of national debt, explore its tangible impact on your wallet and your future.
And we'll even look at how some tech titans are selectively applying science fiction concepts, maybe fueling what some call hyperstition and these kind of fabricated realities.
Our exploration today is powered by a stack of fascinating sources. We've got groundbreaking academic research, detailed interviews with Professor Richard Werner, who's done some really foundational work here.
We also have critical analyses of AI's labor market impact from places like Stanford and Time, plus insightful reports on the, let's say, ethical blind spots of some big names in tech.
Our mission, really, is to cut through the noise. We want to reveal surprising facts that challenge conventional wisdom and connect the dots in a way that empowers you with a clear, more informed perspective on the economic and technological forces shaping your world.
Hopefully you'll have some serious aha moments along the way.
Get ready for those. Okay, let's unpack this first big piece. For most of us, money seems pretty straightforward, right? You earn it, you save it, banks lend it out. Simple.
That's a standard picture, yeah.
But what if I told you that our fundamental understanding of this process is, well, fundamentally wrong?
It's a big claim, but the evidence backs it up.
It turns out that the very foundation of our financial system, how money actually comes into existence, is widely misunderstood, even by, many people within the economic establishment itself.
That's right. It's kind of the biggest secret hiding in plain sight. For a very long time, the prevailing idea, the one most of us were taught, was that banks just act as mere intermediaries.
Right, the middlemen.
Exactly. The financial intermediation theory, it's still dominant in a lot of modern textbooks. It suggests banks simply collect existing deposits from savers and then lend that same money out to borrowers.
So they're just shuffling existing money around.
That's the idea. It's a very intuitive picture. Money flows in, money flows out, the bank manages it. But groundbreaking research has actually proven this theory wrong, empirically wrong.
And not just that theory, right? There was another one.
Yeah, the fractional reserve theory. That one was dominant before, maybe until the 1960s. It admitted the banking system as a whole could create money through this sort of money multiplier effect as banks lend and relend reserves.
Okay, so that one acknowledged money creation, but not by individual banks acting alone.
Correct. It still didn't quite capture the core mechanism. Both of these dominant theories have been shown to be empirically incorrect.
So if banks aren't just matchmakers for existing money, and they're not just multiplying money that's already there in the system,
Yeah.
then what is actually happening? This really challenges the core assumptions we have about how our economy functions, doesn't it?
It absolutely does. The truth, which has now been empirically proven, lies in what's known as the credit creation theory. It's actually the oldest of the three theories, but it was dismissed for a long time.
And what does that one say?
It asserts that banks are not financial intermediaries at all. Instead, they possess this unique and frankly powerful ability to create new money out of thin air the moment they issue a loan.
Out of thin air. That sounds almost magical.
It feels like it, but it's an accounting reality. And the widespread misunderstanding of this process, or maybe even, as some sources suggest, a deliberate obfuscation undeniably benefits a small number of insiders who truly understand how the system operates.
How so? What's the benefit?
Well, if you understand how money is created, you can potentially influence or even manipulate the money supply and, by extension, economic outcomes. You can do it in ways that remain largely invisible to the public and even to many policymakers who are still working off those flawed theories.
That's a staggering thought. So this whole time, the power to generate wealth hasn't solely been with governments printing money, but significantly with these private banks, directly impacting our daily financial life.
That's the core of it, and it explains a lot of the frustration people feel, like the rules are different for some players.
Okay, so how does this money out of thin air actually work then? What's the mechanism? You mentioned empirical proof.
Yes, the empirical truth was really nailed down in a groundbreaking 2014 study by Professor Richard Werner. Astonishingly, it was the first ever direct empirical test of these competing banking theories in something like 5,000 years of banking history.
At first, that's incredible.
It is, and he confirmed the credit creation theory directly. The mechanism is quite simple on the surface, yet profound. When a bank grants you a loan, say, a mortgage, it legally purchases the loan contract, your promise to pay, from you. That loan contract becomes an asset on the bank's balance sheet.
Okay, so they buy my debt, basically. That increases their asset.
Exactly. And simultaneously, at the very same moment, the bank credits your deposit account with the loan amount, say, $300,000 for the mortgage. But here's the key. That $300,000 was not transferred from anywhere else. It wasn't taken from reserves. It wasn't taken from another depositor's account.
It's disappeared.
It just appeared. It's what Werner calls a fictitious customer deposit, in the sense that it didn't exist before the loan transaction. The bank's balance sheet literally lengthens in this process. Both assets, the loan, and liabilities, the new deposit, increase simultaneously.
Wow. So just to be crystal clear for everyone listening, no money is transferred from existing accounts or reserves. Nothing is taken from anyone else's savings account. It's just poof. New money appears in your account when you get the loan. That is definitely an aha moment.
It really is. And Werner didn't just theorize this, he personally demonstrated it in his research. He took out a $200,000 also loan himself and meticulously observed the bank's internal accounting entries. He confirmed empirically that the money materialized in his account without being debited from any other existing funds or reserves.
You actually watched it happen on the books.
Yes. And this isn't some abstract economic footnote. It's the fundamental reality of how most money enters our economy. Roughly 97% of the money supply in many modern economies consists of these bank deposits created by commercial banks through this very lending process.
97%. Not printed by governments, but created by private banks making loans.
Correct. The true takeaway here is realizing that your local bank, not necessarily the government printing press, is the primary source of new money creation in our economy.
This completely upends what most of us believe about money. It's mind-blowing. So what's the most surprising detail that emerged from this research about why banks have this unique power? How can they just do that?
It boils down to a special legal privilege, really. Banks are largely exempt from something called client money rules.
Client money rules. What are those?
Well, most other non-bank firms that handle your money, think stockbrokers, financial advisors, solicitors, they're legally required to segregate your money to keep it off their own balance sheet.
Ah, okay. So if I give my money to a broker to buy stocks, that money stays legally mine. The broker can't just treat it as their own cash?
Exactly. They're merely holding it for you in trust. They cannot claim it as their own asset or use it to pay off their own liabilities if they get into trouble. It remains your legal property.
That makes total sense. So how are banks different?
Banks are uniquely allowed legally to keep customer deposits on their balance sheets. When you deposit money, it becomes a liability for the bank. They owe it back to you, but it's also listed among their liabilities, not segregated off-sheet.
Okay.
Now, combine that with the loan process. When a bank approves a loan, as we said, it creates an asset, the loan, and a corresponding liability, the new deposit in your account. Normally, creating liability like that requires an inflow of funds. But because banks can hold deposits on their balance sheet, and because of accounting conventions, they're allowed to essentially reclassify their accounts payable liability, their obligation to provide the loan funds to the borrower, as a customer deposit.
It is just relabel it.
In effect, yes. Werner describes this somewhat bluntly as the ability to fiddle the records. It's a legal and accounting allowance that lets them invent money by simultaneously creating an asset and an on-balance sheet liability that functions as money.
And you mentioned this has historical roots. It wasn't just invented recently.
Oh no, this goes way back. Werner traces this privilege back to 17th century England and the goldsmiths. People would deposit their gold for safekeeping. The goldsmiths realized people rarely withdrew all their deposited gold at once.
Right. They just needed the paper receipt saying they had the gold.
Precisely. So the goldsmiths started lending out some of the gold they were holding for others. Then they got bolder. They started issuing more paper receipts, essentially loans, than the actual gold they had in their vaults. These receipts circulated as if they were gold.
Ah, the birth of fractional reserve, but then maybe even pure credit creation.
Exactly. This historical trick, lending out more claims than actual reserves, eventually evolved into the modern banking system's ability to create money directly through lending, even without physical reserves playing the direct role imagined in the old theories. It became the foundation of modern banking, a kind of foundational secret, perhaps, because it's the ultimate source of their power and profitability.
And this hidden power, this ability to fiddle the records, has huge implications for how we understand our economy. Which brings us to another astonishing point Professor Werner makes, what he calls the lost century in economics. He claims macroeconomics has made essentially no progress for at least a century because academic economic models routinely exclude banks. How can that even be?
It sounds incredible, doesn't it? But it raises a fundamental question. If banks are so obviously central to money creation and economic activity, creating 97% of the money, why are they systematically ignored or misrepresented in mainstream academic economic models?
Yeah, why?
Vernon calls it a taboo, or perhaps even a secret. He suggests economists often just pretend banks are merely passive intermediaries, like the flawed theories say, because incorporating their true power would likely break the existing mathematical models.
It would mess up the equations.
Potentially, yes. Or it would reveal uncomfortable truths about power structures. It's almost as if acknowledging the bank's true role would unravel the entire theoretical framework many economists have built their careers on.
Is there evidence of this disconnect?
A really telling anecdote comes from the 2008 financial crisis, a major crisis originating in the banking sector. Yet, according to reports, many leading economics professors, even at prestigious places like MIT, admitted they couldn't really explain what was happening because their standard models had no banks in them.
Seriously. During the biggest financial crisis in generations, the models had no banks.
That's the claim. It highlights this profound, almost unbelievable disconnect between dominant academic theory and the real-world financial events that deeply affect all of us. It certainly feeds into that frustration people feel, like, why are we paying for expertise that doesn't seem to grasp reality?
It's astonishing. And you mentioned earlier that it might not just be a passive oversight, that some influential figures might have actively contributed to this obfuscation.
Well, Werner points to some interesting cases. Even the hugely influential economist John Maynard Keynes, who apparently did initially discover and write about credit creation back in 1924.
He knew about it.
Seemingly, yes. But later, in his more famous works, like The General Theory, he regressed, as Werner puts it. He moved away from the credit creation truth, first towards fractional reserve theory, and then eventually landing on the financial intermediation theory, the simplest but least accurate one.
Why would he do that if he knew the truth?
Werner points out, perhaps pointedly, that Keynes's personal financial wealth increased proportionately as he obscured the real role of banks. He eventually became a director and a significant shareholder of the Bank of England, which at the time was privately owned.
So a potential conflict of interest, aligning his theories with the interests of the institution he joined.
The implication is certainly there in Werner's analysis, and he mentions Ben Bernanke, too, before he became Fed chairman. Bernanke published a paper in a Federal Reserve publication that apparently redefined credit creation to essentially mean financial intermediation,
Twisting the definition.
effectively burying the true mechanism of money creation out of thin air within the official discourse of the central bank he would later lead. Werner suggests this helped advance Bernanke's career while keeping the real power of banks under wraps.
Oh.
So this pattern, according to the sources, suggests it might not just be an innocent misunderstanding. It could involve an active suppression or redirection of knowledge that ultimately maintains the status quo and perhaps personally benefits some of those at the very top of the economic and financial hierarchy.
So what does this all mean for us? For the average person just trying to make sense of their finances, save for a house, plan for retirement?
It means that much of what we're commonly taught about how the economy works in schools and the news is either fundamentally incomplete or perhaps, as these critics suggest, even deliberately misleading.
And this benefits.
Ultimately, it seems to benefit a powerful few who do understand these hidden mechanisms of money creation and control. It creates and reinforces that pervasive sense many people have, that feeling you mentioned at the start, that the rules of the game are somehow rigged or at least incomprehensible, feeling frustration about why working hard doesn't always seem to translate into the financial security we expect.
Okay, we've uncovered how money is truly created, and yeah, it's a revelation that changes our entire perspective on the economy. Now let's tackle another huge, often confusing topic. The U.S. national debt.
Ah, yes, the big scary number.
Exactly. We constantly hear about the staggering figures, the trillions, the dire implications. But what if? What if much of it isn't real in the way we typically think about debt? Like not just because it isn't a physical pile of money in a vault somewhere.
Right, it goes deeper than that.
This is a figure that looms so large it influences political debates, economic forecasts, our taxes. Yet its true nature feels deliberately obscured. And it connects back to that frustration, doesn't it? People worry about this massive debt burden on taxpayers.
Absolutely. And the idea that the U.S. debt is, in some fundamental way, not real extends beyond just the physical absence of cash. It fundamentally stems from how the money backing that debt is created. It links directly back to our discussion of bank credit creation.
How so? How does the government borrowing relate to banks creating money?
Well, think about how the U.S. government finances its spending when tax revenue isn't enough. It issues bonds, right? Treasury bonds.
Right, it borrows money by selling these bonds.
Okay, now who buys these bonds? Often a significant portion is purchased by commercial banks. And when a commercial bank buys a U.S. Treasury bond, how does it pay for it?
With existing money.
Not necessarily. Just like when they make a loan to you or me, they can essentially create new money to purchase that government bond. They credit the government's account or the seller's account with new deposits created out of thin air using the bond itself as the corresponding asset on their balance sheet.
Wait, so the banks create money to lend to the government just like they create money to lend to us?
That's a key part of the process. It means the government isn't just drawing on a finite pool of existing savings from taxpayers or foreign investors when banks buy its debt. The banking system itself is expanding the money supply directly for government purposes through this mechanism.
So the government isn't just borrowing money that already exists in the economy. The very act of borrowing from commercial banks can actually create the money it borrows.
Yeah.
That's a seriously mind-bending concept. It sounds completely circular.
It is, in many ways. And this process makes the money underpinning the national debt fundamentally different from, say, you or me borrowing from our savings or taking out a personal loan based on existing funds.
How is different?
That government debt held by banks represents newly manifested purchasing power. It was brought into existence largely through this credit creation process, rather than just being a transfer of pre-existing tangible resources or savings from one part of the economy to another. When these bonds are bought by commercial banks, new bank deposits are created, and those deposits count as part of the overall money supply.
Which ensures that a big chunk of what we call the national debt is basically a creation of the banking system itself tied to the government's need to spend.
Exactly. It complicates the simple narrative of the government borrowing our money.
And this leads straight into that really murky question. Who exactly do we owe this debt to? If banks are creating money to buy it, the simple answers don't seem to fit.
That's right. The notion that we don't owe the debt to anyone in a conventional sense, or that it's fundamentally different, is intertwined with the often opaque and sometimes privately owned structure of central banks.
Central banks like the Federal Reserve.
Yes. Professor Werner, for instance, highlights that the Federal Reserve Bank of New York, arguably the most powerful branch, is described as 100% privately owned by the member banks in its district.
Privately owned, not government.
According to Werner's analysis and historical accounts, yes. He points out its establishment involved, in his words, a hardcore group of insiders, powerful bankers, who pushed for its creation very strategically, famously. Passage happened near Christmas Eve in 1913 when many opposing congressmen were already home for the holidays.
Suggesting a deliberate, maybe even stealthy operation to get it through.
That's the implication drawn by critics like Werner. He describes central banks generally as being controlled by a small number of insiders, often big banking dynasties, who wield immense power over the entire banking system, largely without direct democratic accountability.
So, powerful unelected individuals or families potentially influencing the creation and management of our national debt, operating behind the scenes of the central bank. That definitely feeds into that feeling of an inside game being played way above the heads of ordinary citizens.
It does. And Werner provides a really striking historical example to illustrate this inside game. During World War I, a time of intense national conflict, the head of the German central bank, the Reichsbank, was Max Warburg, and who was one of the key figures running the newly formed American central bank, the Federal Reserve.
Let me guess.
Yeah.
Related.
His brother, Paul Warburg.
Brothers running the central banks of two nations at war with each other.
That's the historical detail Werner emphasizes. It demonstrates how powerful international banking families could maintain influence and potentially coordinate or at least manage financial systems across national divides, even during major global conflicts. It really blurs the lines of national interest versus financial network interests.
It's hard to wrap your head around that level of interconnected power. So when a central bank system, potentially influenced or even part owned by private interests, is involved in creating the money to purchase government debt.
Yeah, the whole who owes whom question gets incredibly murky and complex, doesn't it? It absolutely does. It suggests layers of control and self-interest that are far removed from the public narrative of government simply borrowing from its citizens or other nations.
And this complexity, this
Yeah.
murkiness,
Yeah.
it extends to international debt too, right?
Yeah.
You mentioned Werner calls the idea of borrowing foreign savings a scam.
He does. He challenges that mainstream narrative quite forcefully. Let's take his example.
Yeah.
Say a developing country needs a loan and goes to a big international bank like Barclays in London.
Okay.
According to the credit creation theory, Barclays doesn't lend out existing deposits. It creates the loan amount, say, in British pounds, out of nothing, just like any bank creating credit.
Right, the same mechanism we discussed.
Now, the developing country probably needs its own local currency to spend domestically, not pounds. So what happens? The foreign bank, Barclays, takes the pounds it just created and sells them on the foreign exchange market to a local bank in the developing country. And what does that local bank do? It pays for the pounds by creating new local currency, again, out of thin air, using its own central bank's mechanisms or its own credit creating power.
Whoa. So the loan originates as newly created foreign currency, which is then swapped for newly created local currency. No actual pre-existing savings ever flowed from London to that country.
That's Werner's point. The developing country ends up indebted, owing real resources or future income, often back in that foreign currency like pounds or dollars, but without any actual transfer of existing capital or savings, having entered its economy from abroad to fund the initial loan.
It's like debt conjured on both sides, but the repayment obligation is very real for the borrower. That sounds incredibly exploitative.
Precisely. Werner argues this system often leads to situations ripe for debt for equity swaps, where the borrowing country can't repay the foreign currency debt, and foreign entities end up taking ownership of the country's valuable assets, mines, land, infrastructure, in exchange for canceling the debt that was arguably created out of thin air in the first place.
A mechanism for extracting real wealth using manufactured debt.
He argues the system is almost designed to keep growth low, prevent countries from developing independently. And he doesn't stop there. He suggests that even the middle class in industrialized nations is effectively exploited and drained of wealth by the broader financial system's mechanisms, including how credit is allocated.
So it's a hidden mechanism of global wealth transfer and control, benefiting those at the top of the financial hierarchy while burdening nations and individuals with debt created through these opaque processes.
That's the core argument presented in these sources. It's a very critical perspective on international finance.
This sounds almost too insidious to be true sometimes, yet the mechanics seem rooted in that fundamental credit creation process we discussed earlier, which also leads to that really counterintuitive idea you mentioned, that if the U.S. were somehow to pay off all its debt abruptly, the economy could actually crash. That seems to go against everything we're taught about fiscal responsibility. Why would paying off debt be bad?
It's a paradox, but it's inherent in a system where debt is money, or at least closely linked to money creation. Remember Werner's fundamental principle. Economic activity requires a sufficient money supply. More transactions means more money is needed to facilitate them smoothly.
Right. And you said 97% of money is bank deposits created via lending.
Exactly. And that includes lending to the government when banks buy its bonds. So if the government were to suddenly pay off all its outstanding debt held by banks, what happens to the money that was created when those bonds were purchased?
The banks gave the money to the government pays it back. Does the money just disappear?
Essentially, yes. When a loan is repaid to a bank, the corresponding deposit liability on the bank's balance sheet is extinguished. The money effectively vanishes from the system, contracting the overall money supply. If the government paid off all its debt held by the banking system without a simultaneous, massive, productive expansion of new credit elsewhere in the economy,
You'd get a huge contraction of the money supply.
a massive contraction. This would effectively drain the economy of its circulating medium, its lifeblood, as you put it earlier.
And the consequences would be?
Severe deflation, falling prices, yes, but also falling demand, collapsing investment, widespread bankruptcies as businesses and individuals struggle to find enough money to pay their own debts. It would likely echo the devastating effects seen when central banks allowed large numbers of banks to fail during the Great Depression, sucking money out of the system.
So the current system, however flawed or unsustainable it might seem with this ever-growing debt, kind of relies on continuous credit expansion, including government borrowing, just to keep functioning.
In its current structure, yes. To abruptly halt that process by simply eliminating existing debt without implementing a fundamentally different and functional alternative for how money is created and circulated would be catastrophic. It would trigger almost certainly shrinkage, mass unemployment, and a deep, deep recession or depression.
Which is why just shouting pay off the debt is perhaps dangerously simplistic if you don't understand how the money backing that debt came to be.
Precisely. It highlights the need for a much deeper understanding of the system before proposing radical changes. Werner's own proposed solution, just briefly, isn't about just eliminating debt, but changing the rules of credit creation.
How so?
He suggests a single, simple banking rule. Banks should only be allowed to create credit for productive business investment things that create new goods, services, jobs, and increase the economy's capacity. Not for consumption, and crucially, not for just buying existing assets like real estate or stocks.
So channel the money creation power towards building things, not just bidding up prices.
Exactly. He argues that kind of system would lead to high, stable economic growth without causing inflation or triggering these devastating financial crises and asset bubbles. It's a fundamental redesign aimed at harnessing credit creation for broad prosperity instead of speculation and instability.
We've seen the hidden mechanics of money creation, the surprising reality behind national debt. Now, let's bring it right back home. Let's talk about how these powerful, often invisible financial forces directly shape your daily life, your income, your rent or mortgage, your ability to save for retirement.
This is where the rubber meets the road, definitely.
Because there's this deep-seated frustration out there, isn't there? A feeling, maybe especially among younger generations, that, the political boomers and banking investment boomers, as some might put it, are kind of clutching at their pearls, acting in self-serving ways.
Yeah, that sentiment is definitely palpable.
This feeling that they're making, taking, and creating all the money they can, and that is primarily benefiting them, maybe even at the expense of everyone else's future. Does the analysis from sources like Werner support this perception?
It absolutely does, though perhaps framing it less generationally and more structurally. Werner's core assertion is that many economists, central bankers, and politicians are operating within a mainstream framework that fundamentally misunderstands how money works because they rely on those flawed theories of banking we discussed.
Right, the intermediary or fractional reserve myths.
And this widespread misunderstanding, or again, as he sometimes suggests, deliberate obfuscation directly benefits that small number of insiders who do understand the credit creation reality. It creates an environment where those who control the levers of finance can operate with less scrutiny, often shaping policies that favor asset inflation or speculation over broad-based productive growth. So yes, it confirms that sense of manipulation or self-interest that many people feel is driving the system.
So it's not just a lack of understanding, but potentially a system that actively rewards this lack of clarity. And you mentioned it centralizes power. How does that look in practice?
Precisely. The banking system itself is incredibly concentrated. Werner gives the example of the UK, where just 5 big banks account for something like 90% of all deposits.
5 banks hold 90%.
Wow. And he argues central banks actively pursue policies, regulations, responses to crises that tend to consolidate the banking sector further, reducing the number of independent banks. This, he says, directly increases the power of the central banks themselves and that small circle of insiders associated with the remaining large institutions.
Why would central banks want fewer banks? Wouldn't that reduce competition?
From the perspective Werner presents, more consolidation means easier control and coordination for the central authority. This centralized power means major decisions about credit allocation and monetary policy are made without accountability to the broader public, often by unelected officials. He even suggests politicians often feel they have to do what they're told by these powerful financial entities or the bureaucrats running them.
So less democratic control, more power in fewer hands.
Exactly. And it gets worse. Werner argues that regulators have often been aware of this problem, the flaws in the system, the dangers of misallocated credit for decades, but they choose not to implement truly effective solutions, like his proposed rule for productive credit only.
Why not? If they know it's a problem.
He suggests, quite critically, that they actually like the cycles, the boom and bust cycles that plague our economies.
They like financial crises. That sounds crazy.
His reasoning is that each crisis provides an opportunity, a justification for central banks to be granted more powers, more control, more regulatory oversight. So there's this perverse incentive, a kind of regulatory moral hazard, to maintain a system that periodically breaks down because the breakdown allows the central controllers to increase their own authority.
That's a truly alarming insight. It really does make you wonder, doesn't it? Are those at the top genuinely misunderstanding how the system works, operating with flawed models? Or do they understand it all too well and are actively maintaining a volatile status quo because it ultimately benefits them, enhances their power at the expense of broader society's stability and prosperity?
That's the core tension highlighted by these critical analyses. It suggests the difficulty the average person faces in understanding and navigating these complex financial systems might not be entirely accidental.
And the consequences of this concentration of power, this flawed understanding, maybe even this deliberate maintenance of cycles, we see it clearly in how credit, this created money, gets used, right? The misallocation you mentioned.
Absolutely. When banks are incentivized to make, take, and create all the money they can without strong rules directing that creation towards productive ends, they often misdirect it. A huge chunk goes into simply financing the purchase of existing assets.
Houses and stocks.
Exactly. When banks create new money specifically for buying assets, it doesn't build new things or increase productive capacity. It primarily just pushes up the price of those existing assets. This leads directly to the asset bubbles we see periodically, dot-com, housing, maybe others.
And that drives inequality, right? Because people who already own those assets just get richer without owning anything productive.
Precisely. Their wealth grows simply because the monetary spigots are pointed at the assets they hold. Werner even describes this process starkly as a kind of Ponzi scheme, reliant on ever-increasing prices fueled by new credit that is inherently unsustainable. And the scale is huge. He cites figures suggesting, for instance, that in the UK, around 85% of all bank credit creation goes towards asset purchases, not productive investment.
85%. That is enormous. No wonder housing affordability has become such an insurmountable challenge for so many. The money isn't primarily flowing into building new affordable homes. It's flowing into inflating the prices of the existing ones. That directly hits our ability to buy property.
Exactly. It prices out entire generations. And it's not just asset inflation. What about lending for consumption? Like credit cards, car loans.
What does that do?
Lending for consumption, creating money so people can buy more stuff, now increases the demand for existing goods and services without necessarily increasing the supply of those goods and services. More money chasing the same amount of stuff.
Leads to consumer price inflation. Normal inflation that hits us at the grocery store.
Correct. Werner directly attributed the surge in inflation we saw globally in 2021-2022 to the massive money creation in 2020 by the central banks, which was used for consumption. Things like stimulus checks and other support programs that fueled demand without a corresponding increase in production during lockdowns.
So misallocated credit fuels both asset bubbles and consumer price inflation. What's being crowded out?
What's being suppressed, relatively speaking, is the ideal use of bank credit creation, funding productive business investment. Money for businesses, especially small and medium-sized enterprises, SMEs, to invest in new technologies, build factories, hire workers, create genuinely new goods and services.
The kind of investment that actually grows the real economy and creates jobs.
Exactly. That's the kind of credit creation Werner argues leads to high, stable economic growth without causing inflation or crises, because the new money is matched by new productive capacity. But the current system, with its focus on safer, for the banks, asset financing and profitable consumer lending, means less funding flows to those vital SMEs.
And SMEs are the biggest job creators.
Globally, yes. Sources indicate they employ somewhere between 65% and 70% of the workforce in many countries. Yet they often struggle the most to get bank funding because banks prefer, as Werner puts it, big deals with big customers.
So it really begs the question, doesn't it? If the stated goal of economic policy is genuinely widely shared prosperity, Why is so much of this powerful, newly created money directed towards inflating asset bubbles, fueling consumerism, and concentrating wealth, rather than fostering the productive endeavors that create sustainable jobs and tangible value across the economy?
It's the central contradiction, isn't it? The way the system currently operates seems fundamentally misaligned with the goal of broad-based prosperity.
Okay, this isn't just academic theory. These systemic issues have a direct, often painful impact on your individual prosperity, your ability to secure a home, save for retirement, manage daily finances. Let's drill down into some specific, maybe sobering statistics from our sources that really bring these abstract ideas into sharp focus for the listener.
Right, let's connect the macro to the micro. When we talk about income and wealth disparities, the numbers are quite stark. The median weekly earnings for a full-time worker in the U.S. are around $1,000.
Okay, so maybe $52,000 a year before taxes.
Correct. But after federal, state, local taxes, Social Security, Medicare deductions, that take-home pay often shrinks dramatically, maybe down to around $35,000 to $40,000, depending on the location and circumstances.
That's a big difference from the headline number. What about wealth?
The median net worth for American households is cited as $122,000, but that includes everything, home equity, retirement funds, etc. And crucially, it varies massively by age. For households headed by someone under 35, the median net worth is less than $14,000.
$14,000. That's barely a safety net.
It's very little cushion. And this disparity is exacerbated by what we just discussed. Large banks focusing on big deals with big customers. This means those small firms, the biggest employers, often struggle for the funding they need to grow and create more good jobs, especially outside major financial centers. This contributes to wealth concentrating in big cities and even affects broader demographic trends, like declining fertility rates, as people feel they simply can't afford to raise larger families, particularly in expensive urban areas where the jobs often are.
And housing affordability, as we touched on, is a massive part of this struggle. It feels like the goalposts just keep moving further and further away.
They do. The bank lending directed towards real estate purchases, as we thought, directly drives up property prices, making homeownership increasingly unaffordable for many, especially younger generations, trying to get that first foot on the property ladder. It's a direct hit to individual well-being and long-term wealth building.
And it's not just the purchase price, right? What about ongoing costs?
Exactly. Property taxes have risen significantly. One source cited a 23% average increase nationwide just between 2019 and 2023. And in high-tax states, the cap imposed on state and local tax, OTELI deductions, means homeowners, particularly in high-cost-of-living areas, can become effectively house poor. Meaning they spend such a huge chunk of their income just on property taxes and mortgage payments that there's very little left over for anything else. Savings, investment, even just daily living.
Yeah.
It's a direct consequence of policies and bank lending practices that prioritize asset inflation over accessible, affordable home ownership, making that dream of stable housing just increasingly elusive.
It's a huge source of stress for people. And then there's retirement security, or maybe the lack thereof.
That's another area where the system's flaws really hit home hard. The statistics are quite concerning. Reportedly, a full 25% of Americans have zero retirement savings. None at all.
A quarter of the population, relying entirely on.
Relying solely on Social Security, which provides an average benefit of only about $15,550 per month currently. That's barely above the poverty line in many places.
And for those who do have savings.
Even for those who have saved, the picture isn't always rosy. The median savings for people aged 65 and older is cited as just $88,000.
$88,000 for the rest of your life?
Yeah. If you apply the traditional 4% rule for safe withdrawal, that $88,000 yields only about $300 per month. Add that to Social Security, and it's still far from sufficient for comfortable living, especially with rising healthcare costs.
So why aren't people saving more? Is it just individual choices?
Well, the average savings rate is reportedly only 6% of income, which is far below the commonly recommended 10–15% needed just for retirement alone. But it's hard to save when wages are stagnant for many, housing costs are soaring, and debt burdens are high. Plus, consider this. The average retirement age is around 61, but full Social Security benefits don't kick in until age 67 for most people now.
That's a 6-year gap you have to cover somehow.
Exactly. It creates the significant financial gap that many are unprepared for, forcing them to work longer than planned or rely on inadequate savings or face real hardship. The system makes saving difficult, and the safety nets are shrinking.
And speaking of hardship, let's not forget the debt burden.
Right. The average American household carries over $9,000 in credit card debt alone.
Yeah.
And the interest rates on that debt are often crippling 15%, 20%, 25%, or even higher.
That's just digging the hole deeper.
Absolutely. A lot of this debt might be on non-essential purchases, sure, but it diverts money that could otherwise be used for saving, investing, building wealth. These statistics, taken together, paint a really clear picture. The broader financial system, with its misallocated credit and inflationary pressures, directly impacts individual lives, making it incredibly challenging for the average person to achieve financial security and build lasting wealth.
When you lay out those numbers like that, it becomes undeniable. For the average person, the current financial system just isn't really set up to foster widespread financial security. And again, this isn't about blaming individuals for not saving enough or working hard enough. It's about seeing these powerful systemic challenges that make building wealth so incredibly difficult for so many. It really validates that widespread feeling of frustration and struggle.
And adding another layer of complexity to this picture, especially for younger people entering the workforce, is the differential impact of artificial intelligence on the job market. Findings from places like the Stanford Digital Economy Lab are starting to show a distinct pattern.
Okay. How is AI affecting jobs right now?
Well, the data suggests AI is having a huge effect, specifically on early career workers in what they call AI-exposed fields. Think marketing, customer service, computer science, certain types of analysis.
The jobs AI is good at automating tasks in.
Exactly. The result has been a significant decline, around 15–16% in entry-level hiring in these fields. This disproportionately affects younger individuals trying to get started, and also people in occupations that don't typically require a college degree but involve routine cognitive tasks.
So it's not hitting everyone equally. It's like a new barrier to entry for many young people, right, when they're trying to launch their careers. It's another headwind.
Precisely. It's very targeted. But here's the interesting contrast. Later career workers, and crucially, those workers at any stage who actively use AI to augment their tasks, to enhance their capabilities, rather than just having AI automate and replace their tasks, those workers are actually experiencing stable or even faster employment growth.
Okay, so there's a difference between using AI as a tool versus being replaced by it. Can you give examples?
Sure. The research defines augmentative tasks as things like using AI to help you learn about a topic or to brainstorm ideas or to validate work you've already done, basically using AI to make you better or more efficient.
Okay, like a smart assistant.
Right. Whereas automative tasks involve complete delegation, telling the AI to just write the whole report or handle the entire customer interaction, producing a one-shot output that replaces the human task.
Got it.
The data clearly shows that those who integrate AI in an augmentative way, boosting what they can do, are seeing faster employment growth than the average. This really underscores a critical point for AI labs and companies. There should be an even bigger emphasis on developing and implementing AI to augment human work, not just replace it.
Because one path leads to disruption, the other to potentially shared prosperity.
Exactly. The goal shouldn't just be higher productivity in the abstract, but productivity that leads to widely shared prosperity. And the way we design and deploy AI seems absolutely critical to which path we take.
What's fascinating here is that clear distinction the data draws between using AI to replace human effort versus using it to enhance it. The evidence strongly suggests one path leads to significant job disruption, particularly for those starting out, while the other could foster growth and maybe more equitable prosperity. This connects directly back to our theme of individual prosperity and the future of work in this rapidly changing landscape.
It adds another major force reshaping the economic playing field.
So we've uncovered how money works, how debt functions, and how these systems impact our individual futures and jobs. But to really grasp the whole picture, we need to look at the powerful forces arguably operating behind these systems. We're talking about the relentless drive for centralization in finance, the potential for ultimate control through things like digital currencies, and even the often unseen influence of what some sources call the deep state. How do these deeper structures shape the economic landscape we all inhabit?
Right, moving beyond just the mechanics to the control structures. If we look at that drive for centralization again, Renner emphasizes that central banks actively play a role in consolidating the number of commercial banks. It seems counterintuitive, but fewer banks mean more concentrated power.
You mentioned the UK example. Are there others?
He points to Germany historically. Germany had a highly decentralized banking system for a long time, thousands of small, local, often community-owned or cooperative banks, Sparkassen, Volksbanken. This system is credited with fostering Germany's famous Mittelstand, those highly successful small and medium-sized hidden champion firms.
Because local banks knew local businesses and funded them.
That's the argument. But this decentralized system is now being significantly eroded, according to Werner, largely due to pressure and regulations from the European Central Bank, ECB. He claims the ECB has effectively managed to kill 6,000 banks in Europe through regulatory harmonization and imposing models suited to large, complex banks onto smaller, simpler ones.
6,000 banks gone. That's huge consolidation.
It is, and he points to the U.S. history, too. The Federal Reserve itself oversaw the failure, or chose not to prevent the failure, of over 10,000 banks during the Great Depression. And even in the post-war era, leading up to the S&L crisis and beyond, thousands more banks disappeared. There's been a long-term trend towards consolidation, often accelerated during crises.
That's an astonishing number of banks disappearing over time, and it seems to go against the usual narrative of promoting competition and local economic support. What are the consequences of this consolidation, according to this view?
The consequences are profound, Werner argues. Fewer independent sources of bank credit inevitably lead to more centralized societies. Power concentrates in fewer, larger institutions and in the central bank itself. This means less democratic control over how credit, the lifeblood of the economy, is allocated.
And larger banks prefer larger customers.
Exactly. They prefer doing big deals with big customers, as Werner puts it. This systematically neglects the small and medium-sized enterprises, SMEs, even though they're the biggest job creators. This trend, he argues, quite starkly, amounts to a kind of war against the middle class, intentionally or unintentionally creating a society with more stark rich-poor divisions. Why? Because such a society, he suggests, is very easy to control.
That's a heavy charge. Easier to control.
Yes. So this relentless drive for centralization isn't just some dry economic trend. It has profound political and social implications. It leads to less local autonomy, more concentrated wealth and power, and ultimately potentially a more easily controllable populace.
And speaking of control, this brings us to central bank digital currencies, CBDCs. These are popping up in discussions everywhere now. Are they just the next step in digital payments, or something more significant?
According to critics like Werner, they represent potentially the ultimate tool for central banks to further centralize control. They could even sideline commercial banks entirely and give the central bank direct access to and surveillance over all public transactions.
How are they marketed versus what critics fear?
They're often marketed as digital innovation, greater efficiency, faster payments, financial inclusion, etc. But Vano points out, digital money has been the norm for decades. Most money is already just numbers and computers. The truly new and potentially concerning aspect is the centralization inherent in that first C of CBDC, the central bank aspect.
What's the mechanism of control they worry about?
The fear is that central banks could use CBDCs to open accounts directly for every single citizen. This bypasses the commercial banking system. You wouldn't have an account at Chase or Wells Fargo anymore. You'd have it directly at the Fed, or the Bank of England, or the ECB.
Eliminating the middleman banks entirely.
Potentially, yes. And Werner suggests the shift could even be precipitated, perhaps deliberately, during the next banking crisis, a crisis central banks are, in his view, quite adept at creating or allowing to happen. Offer CBDCs as the safe alternative when commercial banks look shaky.
Okay, so if the central bank holds everyone's account directly, what kind of power does that give them?
This is where it gets potentially sinister, to use Werner's term. It opens the door to programmable control over money. Your money wouldn't just be a neutral medium of exchange. It could have rules attached to it by the central authority.
Rules? Like what kind of rules?
Examples suggested by critics include things like enforcing spending limits based on an individual's calculated carbon footprint, or restricting your ability to spend money if you travel outside a designated 15-minute city zone too often, or even automatically deducting fines or taxes. Perhaps most chillingly, the ability to censor or financially deplatform individuals who criticize the central bank or the government simply by freezing or denying the use of their CBDC funds.
Wow, that goes way beyond just a new payment system. It's potentially a tool for real-time social engineering and control.
That's the core concern. It represents a fundamental shift in the relationship between the citizen and the state regarding money. It could give central authorities unprecedented granular power over individual financial freedom and daily life decisions.
It really raises that crucial question again.
Yeah.
Who truly benefits from this level of centralized control? And what are the implications for personal autonomy, privacy, and freedom in an increasingly digitized world where money itself could become conditional?
It's a critical debate we need to have, looking beyond the surface-level marketing of convenience.
Okay, beyond the formal financial architecture, there's another layer of influence discussed in our sources, what's often termed the deep state. This is a controversial concept, but how do sources like Werner describe it and its alleged influence?
Right, this moves into more geopolitical and intelligence-related territory, but Werner and others he cites connect it back to economic control. The deep state is described in this context not necessarily as a formal organization, but as a powerful, often hidden network, primarily centered around Secret Service operations, particularly the CIA, which has, according to these sources, grown over decades to infiltrate and exert significant influence over various government agencies, bureaucracies, regulatory bodies, and even private sector firms. Critically, it's seen as operating largely without effective democratic oversight or accountability.
That sounds like a shadow government almost. But the sources suggest it's a real force influencing economic and political structures. How?
Werner makes some startling claims, citing declassified documents and insider accounts. For instance, he asserts that the entire project of European integration, the European Union and its institutions, was initiated, implemented, and is still effectively controlled or heavily influenced by the CIA.
The EU, a CIA
Yeah.
project. That's a huge claim.
It is. He states that some of the founding fathers of Europe were literally CIA agents, tasked with creating a supranational structure that would serve American geopolitical purposes after WWII. He argues it was designed to be run by unelected bureaucrats, the European Commission specifically to bypass national democratic accountability, comparing its structure in terms of democratic deficit to the old Soviet Politburo.
And the location of EU institutions.
He notes that the presence of NATO headquarters in Brussels alongside the main EU institutions is not a coincidence, reinforcing the idea of an integrated geopolitical and economic power structure operating outside direct national controls.
And this alleged influence extends beyond creating institutions. What about within nations?
Sources cited suggest that intelligence agencies like the CIA actively recruit assets within foreign governments, help sympathetic politicians get elected, and ensure influence within key governmental structures. Werner even claims they have infiltrated congressional oversight committees in the U.S., essentially rendering them ineffective in controlling the agencies they're supposed to oversee.
That sounds like a complete undermining of checks and balances.
It does, and the analysis goes further, linking this network to more overt actions like assassination as ultimate intervention policy and numerous regime change operations globally when leaders don't align with certain interests.
Assassination. That's extreme.
Werner points to the case of Fletcher Prouty, a former high-ranking U.S. military and CIA liaison officer who became a whistleblower. Prouty alleged the CIA was involved in the assassination of President John F. Kennedy. Why? Because Kennedy had challenged the power of the privately influenced Federal Reserve and had taken steps indicating he wanted to abolish or drastically curtail the CIA itself.
So challenging the financial system or the intelligence apparatus could be dangerous.
That's the stark implication. Werner adds another chilling detail from his sources. The U.S. Secret Service's original mandate, when founded, was primarily to protect the integrity of the U.S. financial system combating counterfeiting. Protecting the life of the president was only a secondary mandate added later. It suggests a prioritization, historically at least, of the system over the individual leader if they threaten that system.
That really reframes things. What about other global organizations, like the World Economic Forum?
The WEF, often seen as a hub for global elites, is identified by Werner and related sources as another operation with significant intelligence links, potentially originating from the CIA. He reports its founder, Klaus Schwab, was recruited by Henry Kissinger, himself a figure with deep ties to intelligence and power structures, at a CIA-funded academic seminar at Harvard early in his career.
And the purpose of the WEF in this view?
Its purpose, according to this critical perspective, is to serve as a platform to influence and manipulate global opinion leaders, CEOs, politicians, and academics, essentially, to shape global narratives and policy agendas in line with certain interests, often related to economic globalization and technological governance.
There also seems to be a strong link suggested between central banking and war.
Yes, Werner emphasizes this connection. The Bank of England, one of the earliest central banks, was explicitly established in the late 17th century with the primary purpose to make war, specifically, to finance England's wars against France more effectively than the state could alone.
So central banking was born out of military necessity.
In that instance, yes. Similarly, he notes the Federal Reserve was established in the U.S. just shortly before America's entry into World War I. Its creation conveniently coincided with the introduction of the federal income tax, which provided the government with a revenue stream it could borrow against, primarily by selling bonds to be purchased by the new central banking system, thus facilitating war finance.
And we already mentioned the Warburg brothers running the German and U.S. central banks during WWI.
Right, illustrating that inside game that seems to transcend national loyalties during conflict, underscoring the profound, often hidden influence of these financial and intelligence structures on our economic policies and geopolitical realities.
This is a truly eye-opening and frankly disturbing perspective. It suggests our world might be shaped by forces far beyond what most of us imagine, certainly beyond direct democratic control or understanding. It paints a picture of deliberate systemic influence, which certainly resonates with that feeling of powerlessness or that the game is rigged that many people express.
It definitely provides a framework for understanding that frustration, even if the specific claims are controversial and challenge mainstream narratives.
Okay, shifting gears slightly, but staying with powerful shaping forces. Let's talk about the tech titans. People like Elon Musk, Jeff Bezos, Mark Zuckerberg, Sam Altman. Our sources explore the ethical implications of how they seem to selectively apply concepts from science fiction. How does this play out?
It's a fascinating angle. Tech leaders are often very open about being inspired by science fiction. They grew up reading Asimov, Heinlein, Gibson, Stevenson.
Right, you hear them reference it all the time.
But the critique is that they tend to cherry-pick the cool concepts, focusing almost entirely on the shiny technology part of these sci-fi ideas. The gadgets, the AI, the space travel, the virtual worlds.
And what do they ignore?
What they often seem to actively ignore, or at least downplay significantly, are the social, political, and economic implications, often the warnings that the original science fiction narratives explored in depth. Sci-fi authors frequently use futuristic tech as a lens to critique power, inequality, unintended consequences, and the potential dehumanizing effects of technology.
So the tech leaders are grabbing the cool invention, but missing the cautionary tale that came with it. Is it just an oversight, like they're just excited engineers? Or is there something more concerning going on?
The analysis suggests it might go beyond mere oversight sometimes. There are instances where tech leaders seem to adopt elements from explicitly dystopian science fiction, not as warnings, but as actual visions they actively want to bring about.
Dystopian visions as blueprints? Can you give an example?
The most prominent example cited is Mark Zuckerberg's embrace of the metaverse. The term and concept are heavily drawn from Neil Stephenson's novel Snow Crash. But Snow Crash isn't a utopian vision. It's widely described as a sharp dystopian satire critiquing corporate power, social fragmentation, and escapism into virtual reality.
So Zuckerberg took a concept from a cautionary satire and made it his company's core mission.
That's the concern. It raises serious questions when powerful individuals seem to be intentionally, or perhaps just carelessly, constructing futures that resemble the very dystopias they initially consumed as entertainment or critique. They seem to be missing the point of the original work entirely.
And this fuels something called hyperstition. What is that?
Hyperstition is a concept suggesting that ideas, especially fictional ones, can actively shape reality. When powerful actors believe in a fictional concept and start investing billions to build technologies based on it, they can actually make that fiction become real. So, the selective reading of sci-fi isn't just passive consumption. It becomes an active force translating fictional ideas, even those explicitly presented as warnings, into real-world technologies and social structures. They are literally creating the futures that were once only imagined, sometimes the futures we were warned against.
That's wild. It's like they skipped the second half of the book where everything goes wrong.
Exactly. What's fascinating, or maybe alarming, is how these powerful figures seem to miss the fundamental narrative arc of so much science fiction. It's rarely just about, wow, look what we could build. It's primarily about asking, okay, but what happens if we do build this? What are the profound, often unintended consequences for society, for humanity, for power dynamics? They seem to selectively extract the appealing technology while completely discarding the inherent social commentary and ethical warnings. This definitely feeds into concerns about unchecked egos pursuing grand visions without adequate consideration for the potential fallout.
And this selective approach, this focus on tech over consequences, seems rooted in a particular ideology, something called techno-solutionism.
Yes, many tech leaders appear to subscribe, consciously or not, to an ideology of technosolutionism. This is the belief, often deeply held, that nearly all complex political, social, and even existential problems can ultimately be solved through the application of more and better technology.
So technology is the answer, no matter the question.
Pretty much. This perspective often leads them to perceive almost unlimited upside in their innovations, changing the world, connecting everyone, solving intelligence, extending life without adequately considering the downsides, or asking crucial questions like, who is harmed by this? Who's losing out? What are the broader societal and ethical trade-offs?
It creates a kind of ethical blind spot.
A profound one, yes. It results in a frequent failure to anticipate or mitigate negative consequences, even when, as we discussed, the original sci-fi that inspired the tech explicitly warned against creating it. You even have some individuals within the AI industry candidly acknowledging they might be creating technology with the power to destroy the world, and yet for some reason they continue to work on it.
That is a truly unsettling admission. It suggests a serious disconnect between understanding potentially catastrophic risks and the powerful drive to just keep pushing forward, regardless. That has enormous implications for our collective future.
It really does. And when you look at some of the grander ambitions, like Elon Musk's Neuralink project aiming for brain-computer interfaces, or Jeff Bezos' focus on space colonization, these are often explicitly rooted in what sources describe as extreme ideologies.
Extreme ideologies. Like what?
Things like transhumanism, the idea of fundamentally enhancing human capabilities through technology; extropianism, seeking perpetual progress and overcoming limits like aging and death; singularitarianism, belief in an impending technological singularity; cosmism, a Russian philosophy influencing space exploration ideas, alongside strains of rationalism, effective altruism, and long-termism.
That's a lot of isms. What's the common thread?
The common thread is often a desire to use technology to fundamentally reshape the human condition, to build tech-enhanced humans, transcend biological limitations, and ensure the very long-term survival of humankind, often through technological means like becoming multiplanetary.
Which sounds ambitious, maybe even noble in a way.
It's presented that way as pushing humanity's limits. But critics argue these visions carry significant ethical risks. They can prioritize a very narrow, technologically driven definition of human progress over broader well-being, social justice, and equitable access here on Earth. There's a danger of a few powerful individuals essentially playing God, shaping humanity's future according to their own specific, often techno-utopian or even quite strange designs. This could dramatically exacerbate existing inequalities or create entirely new forms of control and stratification.
So what does this all mean for our future, tying it all together?
It means that the individuals who have an outsized influence in shaping our technological landscape, and therefore increasingly our social and economic landscape, often operate with what appears to be a profound ethical blind spot. They seem driven by immense self-belief, sometimes vast self-interest, and often a narrow vision of progress that could inadvertently lead us down paths many science fiction writers explicitly warned us about. This can create huge unintended consequences and further exacerbate the inequalities baked into our current systems.
It's a situation where the desire to build the future as imagined in fiction seems to overshadow the critical evaluation of its real-world costs, benefits, and dangers. It contributes to that feeling that the world is being shaped by people who claim to understand it best, maybe even claim to be saving it, yet seem to miss the fundamental human and societal implications of their own creations.
It adds another powerful layer of complexity and concern over who holds the reins and where we might be headed.
Wow.
Yeah.
Okay, we have really navigated a complex and frankly often startling landscape today.
Yeah.
We've gone from the hidden mechanics of how money is actually created
Yeah, the 97% created by banks.
to the arguably not real nature of national debt, the concentration of power in central banks, the potential influence of a deep state.
And finishing with the selective, sometimes ethically blind visions of tech titans who are actively building our future, inspired by sci-fi they might have fundamentally misunderstood.
It's a lot to take in.
Yeah.
As you've been listening, what stands out most to you from this deep dive? What's the piece that made you go, uh-huh, or maybe, uh-oh?
It's worth reflecting on because these aren't just abstract theories for academics or policy wonks.
Not at all. These are the unseen currents, the underlying structures that are profoundly shaping your ability to buy a home, your chances of saving enough for a decent retirement, how you navigate the job market with challenges like AI, and even the kind of future society you and your children might inhabit.
That pervasive frustration we talked about, the struggle with housing affordability, the anxiety around retirement security, the shifts in the job market, they aren't just happening in a vacuum. They are deeply, deeply tied to these systemic, often hidden forces we've explored today.
Understanding how money is actually created and directed, who
Mhm.
truly controls the levers of our financial and technological systems, and what the underlying motivations behind those decisions might be. It can be an empowering first step,
Mm.
maybe just an understanding why things feel the way they do.
Indeed. If you've ever had that nagging feeling that the system wasn't really designed for your benefit, or that you're constantly running just to stay in place while others seem to leap ahead, well, this deep dive offers some pretty profound potential explanations for that feeling.
The data we looked at shows clear impacts on individual financial stability, from those declining entry-level job prospects for young workers due to AI automation, to the systemic forces pushing housing further and further out of reach for ordinary people.
It really underscores how the choices made by a concentrated few in finance, in central banking, in technology ripple outwards, affecting every aspect of our lives, creating the very economic realities we experience day to day.
So as we wrap up this deep dive, here's a final, maybe provocative thought for you to chew on. Considering how deeply intertwined our financial systems, these geopolitical power structures, and the often self-directed visions of technological innovators seem to be, how can individuals and communities realistically foster true prosperity, genuine economic stability, and meaningful self-determination, especially when so many of the fundamental mechanisms appear opaque, highly centralized, and potentially driven more by insider self-interest than by collective well-being?
It's the fundamental challenge, isn't it?
And maybe more pointedly, what tangible steps can we take armed with this kind of knowledge, however unsettling it might be, to demand greater transparency, more accountability, and maybe begin to push for a real shift toward systems that genuinely prioritize widely shared prosperity, long-term stability, and careful ethical foresight over concentrated power and, frankly, unexamined technological progress? What will you do with this knowledge?